Welcome to Swing Trade Pro, a three-part educational offering from Pivot Boss with Frank Ochoa. This is part 2 of Swing Trade Pro, swing trading setups and pro style entry techniques. When it comes to triggering professional style entries into the market, it's all about location and technique. And that's exactly what you're going to learn in this section. I'm going to reveal the intricacies of triggering amazing entries, which you can use in any market and in any instrument you trade. I'll also teach an array of setups that are designed to help you capture high probability moves in the market. Taking the time to really master these techniques will go a long way toward advancing the state of your trading and in return, your bottom line. We've got a ton to cover in this section, so I'll be going at a fast pace. But you'll be able to replay this section as many times as you like. So let's go ahead and get started with part 2, swing trading setups and pro style entry techniques. We're going to start with importance of trade location. The market is a market. While traders often call it the market, many fail to realize that it is indeed a market. Trading is a game of inches and every tick counts. While most traders understand and call it the market, I don't think a lot of traders really understand that it is indeed a market without fixed pricing. True markets do not have fixed pricing. You're able to barter or negotiate at true markets, like a farmer's market or an artisan market. And just how you approach those markets, you should also approach negotiating your entries in the stock market, because every tick, every penny, every dollar counts over time and contributes to your overall profitability. The market is an auction, so you should negotiate your trading like you're bidding at an auction. Be picky, bid low, and always try to get the best price possible. Novice traders routinely enter a trade and watch price go against them immediately. How many times have you done this? You get into the trade and immediately price goes against you. You always have to weather that initial storm as price goes against you, right? It's been me. I've done that as well. But you know what? I decided to say, instead of getting in where I usually would get in, how about I let the trade go against me before I enter the trade? And then I get a better entry upon that, initial reversal. And that's all about discipline. It's all about letting price come to you. Bid low and patiently wait for price to come to you. And you know what? You can always sit on your hands. Not trading is an option, and oftentimes is the best option. Never be in a rush to get into a trade. Instead, throw out your feelers. Throw out a very low bid and say, you know what? This is where I'm comfortable getting into this trade. And if the market fills you, you're in. And if it doesn't, you know what? Throw out another feeler somewhere else. That's what trading is about. It's about getting the best prices you can. Because if you can get great entries, great trade location, you're likely going to have a profitable trade. I don't always get filled on my limit orders, but you know what? When I do get filled, it's oftentimes at a great entry, and price will only go against me a few ticks before it goes into my direction. And that's what we're going to learn in the first part of this section. It's all about trade location. The secret to making more money out of each trade is trade location. Because instead of letting the trade run off into the direction that you choose or that you hope it moves into, how about you make money on the front end as well? That way you're putting less emphasis on the trade after you get in. But you know what? If you make money on the front end, you're always making a little extra on each trade. You're always stretching the profit potential of each trade because you're getting better trade location. Better entries means more profit potential. Better entries also means less risk because you're closer to the getaway exit. Less risk also means smaller losses. And you know what? By negotiating your entry properly with limit orders, you're virtually eliminating slippage. Slippage is just a way to continue to siphon money out of your account. So if you use the right approach to triggering these entries, you'll completely eliminate that slippage component, and you'll also add the additional profit factor that you're going to make from the front end of each trade. Defining your trade location requires discipline, as does a lot of facets in trading. But discipline leads to profitable trading. It's the discipline to have the attention to the minor details that leads to profitable trading. So when I talk about negotiating the entry, let's just have a quick heads up about what we're going to be learning about. This is typically a very, very bullish candle. This is an outside day or outside candle engulfing pattern where this candlestick completely engulfs the prior candlestick. It's a thrusting pattern that is very, very bullish. If you combine that with volume, you probably see there's a volume spike here as well, and you can see that price is ready to go higher. Most traders will wait for this candle to fill or get in somewhere at the top part of this candle or wait till the next bar to open before they enter, and their entry will be somewhere between 33.1 and 33.2. What I'm asking you to do is negotiate your entry. You see this as a great bullish opportunity? It is. But you know what? Instead of getting in here, set your limit order back toward the center of the overall candlestick. You can see the high was 33.12, the low was 32.28. That makes the midpoint 32.70. The exact midpoint is 32.70 right here. How about you set your limit order to buy at that point? So when price drops down into that zone, you already have a limit order ready to trigger. So when you look at the next chart, you can see that price didn't come back to fill that on the next day, but it did 2 days later. 2 days later, the low of that point right there was 32.61, right here. You got in 9 ticks from the low of this move because you negotiated your entry. How about the rest of the novice traders getting filled right here where I said they would? Somewhere around 33.10 to 33.20. Well, price gapped up to right there. A lot of folks got filled here, and then price dropped down the rest of the day. So immediately the trade has gone against them. But you put your trade at the center of the candlestick and said, you know what, that's a great opportunity, but I want an even better price. I'm requiring better trade location. And when you do that, you'll see oftentimes you are filled at an amazing price, 9 ticks from the low. You just made an additional 1.5% on that trade by getting a better entry on the front end of that trade. From here down to here is 1.5%. You just made this, and then you made that. That's what we'll be talking about. Here's another example. This is a bullish gap from an accumulation phase, which we talked about in part 1 of this course. But instead of getting in at the top part of this day, after the candle is done, or getting in at the open of the next day, how about you set a limit order at the center of that bar? Again, let price come back to you, fill it, and then get long. The high, 1950. The low, 1910. The center, 1930. So we're putting our limit order at 1930. What happens? Price gaps down the next day, rallies, and then drops back down, and then closes back toward neutral. But you know what happened? You got filled 2 ticks from the low of that bar. 2 ticks from the low. Then price went up the next 2 days, came back to retest that portion, and then rallied up to 2085. But by having the discipline to set your limit order at the center of that range instead of up here, you gain an extra 1% on that trade. You gained an extra 1% on the front end of that trade. Having great trade location puts money in your bank account and allows you to have a better trade outcome overall, regardless of if you hit your target, your profit target, or hit your loss stop. It's a better trade overall, because if you hit your loss stop, you're closer to where your loss stop is. Since you didn't get in way up here, you're 1% closer to your loss stop. Secondly, if it does hit your profit target, you made 1% more. So regardless of the outcome of your trade, it's going to be a better trade. That's why you need to have great trade location every single time. Pro style entry techniques. Now we're going to get into the nitty-gritty of how I enter the market. These pro style entry techniques will go a long way toward making you a better trader. Study these techniques, practice these techniques and employ them because they will help you get better trades every single time. The pro style entry techniques that we'll be covering are techniques that provide a consistent approach to triggering your entries regardless of the time frame you trade. So if you're trading swing trading, this is a swing trading course, we're looking at this from a swing trading perspective. But these techniques can be used on 1-minute bars all the way up to monthly bars. It doesn't matter. So understanding these techniques will improve your overall trading approach. What these techniques do is they force you to be disciplined. They force you to try and get a better entry. And you know what? If you don't get that better entry, then you don't get in the trade. And you wait for the next one until you are filled at that better entry. These entries, as we just saw in the prior examples, help create more profit potential on the front end of the trade. They reduce slippage and risk, and they provide a reliable way to trigger entries in any time frame for any setup. Now, the 3 entry style techniques that we're going to be talking about are the ambush entry, the retest entry, and the threshold entry. These techniques we're going to be learning to use for different style trades, and the idea here is that you understand and know exactly when to use each of these techniques. Now, we're going to start off with the ambush entry, which is a very high risk style entry. You have to have it in your arsenal, but you don't have to use it all the time. But you have to know when to be able to use it, and we'll talk about that. We're going to look at the retest entry, which is the Pivot Boss preferred style entry. This is the entry I use for virtually 95% of my entries. And the threshold entry is the one that I would potentially use as much as ambush, or maybe even a little bit more. But the threshold entry is a more confirmed approach to entering the market and provides a lower risk factor. But of course, the trade location goes from best down to not as good. So ambush, you're always going to get the best entry or trade location possible. Retest, you're going to have a little bit less of a better entry, but still great. And threshold, you're going to have the least good trade location, but it's still going to be good compared to other facets. So let's start off with the ambush entry. Professionals deploy the ambush entry by placing a limit order at a level where price has yet to trade in anticipation of a reversal. So if you look at the graphic here, basically if this is your support level and this is, day 1, day 2, day 3, etc., and price is you anticipate that price is going to drop into that support level, place a standing buy limit order right here, anywhere in this zone, either below, a few ticks below the support level, right at the support level, or a few ticks above that support level. Place that entry there. So when price opens on this day and begins to drop down into that support level, you already have an order there ready to ambush that price test. And once price drops into that zone, you're automatically triggered long, and then you're in at the best possible point. Now, it's very important to keep in mind that this ambush entry is extremely risky. Very high risk factor associated with this entry technique, but you have to know when to use it, and you have to use it at price levels that offer either established support or resistance, or a confluence of support and resistance, some type of high confidence factor that area is going to see a reversal. So if you have that high confidence factor, you can use this trade. And I'll show you those setups where I have a very high confidence factor that will see a reversal, and I use this ambush entry for those. For example, if we're looking at this support level, there's no denying that support level is real. Bounce, 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 bounce. All these bounces and tests. Another bounce and test. So if price is dropping down into this zone, and you know that the market has supported or defended that zone as a support level, you can place your limit order right here in anticipation of a test. And when price drops into that zone, you're going to get filled right in this area. As I mentioned before, you can also put your limit order a few ticks below support. And then when price drops down for a deep test, you're getting filled down here because there are limit orders to buy down here. The market is fishing that zone, and then price jumps back up. So you can put it a few ticks below, right at the level, or a few ticks above. Depending on the setup, I'll use any of those approaches. So it just depends on your confidence in that potential reversal or your comfort level with using this approach. Here's an ambush entry for Ford Motor Company in a daily chart. Again, a very clearly established resistance level. It's well defined. We've seen the market trade in a range back and forth for 2 months in this period, and now price was rallying into that resistance level. We can put a limit anywhere in this zone right here. Price rallies up, fills our limit short, and then you see the big reversal from 13 down to 12.30. Again, you have to have a high confidence factor in using this entry because if price breaks through that zone, it's just going to keep on going. So you have to have confidence that we're going to first see a reversal at that point. And if not, you have to have your stop ready to go above it. And we'll talk about stop techniques in part 3 of this course. This is when I have a high confidence factor in using this ambush entry. It's when I'm using volume weighted average price. We'll talk about this indicator and this level and this setup later on in this course. But right now you can see VWAP is trending lower, an established markdown period, and when price rallies into that zone, you can place your limit order at or just above VWAP and it'll get filled. Now, of course, price smashed through there and then returned back, so that made it a very difficult hold. This one was much more along the lines of what you would hope to expect out of a trade like this, where price rallies into it, only goes a few ticks past or a little bit past VWAP, but it's filled at that level. You can push your limit order right at that level, get filled, and now you're filled at the wick. But either way, when I'm looking to trigger this entry, I start with placing my limit above VWAP. And if price doesn't quite get there and starts to move around, or I think it's going to go shorter than VWAP, then I move it down to VWAP. And if I'm really feeling like we're not going to even test VWAP before getting reversal, I might drop it a few ticks in front of it. So you can see my progression. But the idea here is you have to have a high confidence factor that we're going to see a reversal. In an established markdown phase, every tested VWAP should be seen as a selling opportunity, high confidence factor in that, and you place your limit there and hopefully get filled. Now the retest entry is my preferred style entry. Again, I use 95% of my entries go to the retest entry style approach. And basically, this approach basically tells you to allow price to test that support or resistance level. Allow price to test that zone. And once you see how the market's going to react to that zone, then use that information in order to place a high probability limit order somewhere within that prior test period. So what's happening here is, here's that ambush entry that we talked about in the last section here. Well, instead of placing your ambush here, because that's a very risky approach, let the market test that zone first. Here's the market dropping down, testing it, and then rallying to close on a high. Okay? This is a successful test. That's what you would expect at a clear area of support, is the market testing that zone, finding buyers immediately, and then closing on a high. So what you would then do is place a retest entry down toward the center of this entire candlestick or at the center of the wick. Somewhere in this zone. Place your limit order there. So when price opens the next day and drops into that zone for a test, your order is waiting there to be filled, and then price rallies to the close. So now you're in at a very great trade location. You know that this is a zone where the market bought in the prior day, and if price drops into that zone again, it's likely going to see further buying, and then we're going to get a move up. So this is my preferred style entry. If you can master this technique, you can do it on any candle you want, on any time frame you want, for any setup you want, and you're going to improve your entries dramatically. Let's look at this in practice. Here is a very clean up move. We got the pullback, and look at this candlestick right here. Very bullish reversal candlestick. Price dropped down, found buyers immediately, and then price rallied back toward the open of the day. Well, if I like this candle and I think it's very bullish and I think we're about to see a wave up, what I'll do is I'll place my limit order at the center of this range. Boom. right about there. So when the market opens the next day and drops into that zone for a retest of that value, my order is there, ready to be picked off, filled, and then I'm in at the best possible point. Sure, the market can drop down the next day and I can get stopped out, but if it did that, my risk is very, very small. And if it doesn't do that and continues higher, I've just maximized my gain big time because I've captured virtually the entire move. And secondly, I've made money on the front end as well. This is another one. Looks very similar because oftentimes these are very similar, but there's no magic formula or secret recipe when it comes to these things. All it is a necessity. It's a necessity to have to be filled at a better price than everybody else is getting. Even if it's by a tick or two. If you can get a better price even by a tick or two, you're increasing your profit margins. In this case, very nice buying wick here. After that little small pullback, that buying wick right there tells me there's buying interest now, and we're likely to see an up move. Well, when price opens the next day, we can put our limit order at the center of the wick. When price drops down into that zone, we're getting filled, and then we get a nice up move as a result. That's exactly what I want you to do. If you think this bar right here is going to lead to an upswing, don't fill yourself at the open of the next bar or upon a crossing of this bar. Don't do any of those things. Instead, drop your limit way down and say, hey, you know what? I'd like to get long, but I want you to come down to my price level. And if they do, you get a great entry. If you don't, you miss the move and you go on to the next one. Let's talk about the threshold entry now. The threshold entry basically is an entry that allows you to capture a breakout move, which is a much more confirmed move, but it allows you to basically manage where you're going to get into the trade. It gives you a little bit more control of how you enter that move. Instead of just plopping a market order there when price is breaking through and getting filled wherever, put a stop market order. At least you have your order there ready to go, and then you're going to have maybe a little bit of slippage, but at the same time you're ready to go, you have it placed, you're in front of the rest of the folks that are just going to push buy or sell at that point. And it's still a very nice confirmed approach to getting filled. So basically you're putting a stop market order a few ticks past a recent higher low in order to fill upon a crossing of that level. So when we're looking at here, this threshold entry, it allows you to control your price, at least somewhat. It allows for more confirmed entry. So sometimes you need that extra confirmation in order to trigger that trade. And this is a great example here. You have a very nice gap up out of an accumulation phase, a gap out of range, and that's good. That usually signals a very nice upswing to come. However, look at this first candle here. Opened, rallied, found sellers, and dropped. So it's not the most bullish candlestick. I still like the overall flow and the potential that we're going to see more movement to the upside, but I don't want to fill upon a pullback here because this could be a topping pattern that leads to a fill. So instead, I want to require that price break through that candle high. And if it does, I have my stop market order ready to be filled at that level. You fill your stop market order, and then you're in at that level and continue higher. This is the approach that I would take in this scenario. But we'll talk about how we can use this over and over throughout the rest of this part 2 course. Because not only can you use it for breakouts, but you can also use it to reversals as well. So for example, here's VWAP again. Every time price tests that level in a downtrending market, you see a reversal. Here's testing it, a reversal. Here's a test, beautiful test. Look at the wick. Look at that reversal candlestick. That is beautiful, exactly what you'd hope. That means a market opened here on that candle, rallied strongly, found major sellers in that zone that pushed price back down. Right there, That's the market smacking down any advance. You know you're going to go lower. Well, if you missed out on this point, because you know what I would do? I put my retest limit right here, and I try to get filled. Uh-oh, doesn't look like we're going to get filled. And instead we start to move down or get squirrely there. I'm putting my stop market order right here in order to get that last ditch entry. This is my last ditch entry right here. I'm still getting a nice reversal entry. I'm still getting great trade location. I'm still getting a nice confirmation that we're going to get that move. I'm not getting the best trade location I can, but the train is going to leave me whether I'm on it or not. This is my last attempt to get filled at a good price because I'm not going to get filled here or here or here. That's just not good trade location. It's not a good way to do business. Now that we have those three major pro style entry techniques under our belt, we're going to talk about intraday entry techniques now. And with the intraday entry techniques, what these do is they allow you to drop down into an intraday chart to trigger swing trading opportunities. So those techniques that I just taught you can be used in any time frame, but for the most part, those techniques will be used in a daily time frame for these swing trades, right? But these intraday techniques here allow you to drop down into the intraday chart to get a better or more confirmed entry or a more precise entry. And they allow you to get into a swing trade on an intraday entry that you can then manage either intraday or manage in a daily chart. These intraday techniques provide a systematic approach to entering trades, and that's an important adjective, a systematic approach. That's the whole goal behind all of these pro style entry techniques. They're systematic approaches to entering the market. It gives you a set of guidelines on how to enter the market. And if you can just follow those guidelines over and over and over again for every single entry you ever take and the rest of your trading career, you're going to do better. So what these intraday techniques allow you to do is they provide a little bit more confirmation, a last step before entry. So it's almost like a setup within a setup at times. These intraday entry techniques can also be used as setups in their own right for intraday trading, which also makes them setups within setups. But they provide consistency, they provide additional confirmation, and they provide a great way to further confirm the overall setup that you're trading. And these intraday techniques are the opening range breakout, the opening range reversal, and the value area reversal. So the opening range breakout basically says, let the first 30-minute range, the opening range, let the first 30 minutes of the day play out. And once that opening range develops of 30 minutes, trade the breakout from that opening 30-minute range. So you would place a stop market order just beyond the high or low of the 30-minute range, depending on if you're triggering a buy or sell entry. And that's your entry. The opening range reversal, on the other hand, is kind of the opposite. You allow the 30-minute opening range to develop, but instead of triggering on a breakout through a high or low, you trigger upon a reversal of the opposite level. It provides more profit potential, but it's also riskier. And then, of course, you have the value area reversal, where we're using the value area, a higher or lower relationship, in order to trigger reversals in the market. And of course, we'll be using the pivot range, which we covered in part 1 of this course. The opening range breakout entry is very simple. Basically, you allow the first 30 minutes of the day to play out, and once they do, you trigger an entry upon a breakout through the high or low, depending upon if you're buying or selling. Okay? Now, the 30-minute range is standard, typically, among traders, but you can use any periodicity you want, or any time you want. Some use 15-minute opening range, some use a 60-minute opening range, which is the initial balance. Some use a 5-minute opening range. I like the 30-minute opening range. It's a very, very good range. It's kind of the catch-all type of ranges. If you're going to use a range, the standard is 30 minutes. And then you can tweak. You can go down to a 5-minute opening range if you want to, a 15 depending on the setup, maybe a 60 depending on the setup. But it's flexible and customizable in that way. So what you're doing here is you're saying, okay, here we have a markup phase. We've gotten our pullback, and now we've formed, first of all, an outside reversal day, an outside candle day. And then we formed an inside day here, whereby this candle formed inside this day. We're going to talk about this setup later on in this section. This is an inside day that usually leads to a breakout. That breakout, since it's in the markup phase, should be to the upside. What I want to do is drop down into an intraday time frame in order to trigger that entry. So when I drop down into an intraday time frame, here's the inside day that we just looked at. This is the outside day, and then this is the inside day inside that range. Well, when the market opens the following day, it builds out that opening 30-minute range. Once the 30-minute range is fully developed, you place a stop market order to buy just beyond the high of that range. And once price gets up there, triggers that entry, we're long. Now we're in a swing trade, but we did it on an intraday entry. That is the basic approach to entering this style of trade. Now here's another one. Let's look at this one. This is another inside day example. We have this day here, big nice day, wick on the top. Then we have an uncertain candlestick, a spinning top type candlestick, and an inside day formation. This inside day formation right here indicates that we could see again another breakout. Since we're not really sure about which direction we're going to see a breakout, we can drop down into an intraday chart and trade the 30-minute opening range breakout as our entry, because this one could break to the upside and keep going up, or it could break to the downside and go down for a mean reversion type of trade. So we don't know. We know right now that it did go down, but we don't know at the time. So what we do is we drop down into the intraday chart. Here's a 5-minute time frame. Here's the inside day. So this price action was inside the prior day. You can see how coiled up it was. You let the first 30 minutes play out. That's the first 30-minute range right here. Boom, boom. Now, of course, it took hours before it broke that range, but eventually it broke to the downside and triggered our entry short with a stop market order here. Now, keep in mind, and this is a very big caution right here, is you do not want to trade a 30-minute opening range breakout if the 30-minute range is super, super wide. You want it to be normal size compared to the average opening range, or you want it to be more narrow than usual. More narrow is best. Average is good. If it's too wide, like for example, look at here, the opening 30-minute range is from here to way up here. That is not a good opening range to trade for a breakout. When you have a wide opening range or a wide initial balance, that usually leads to trading range behavior the rest of the day. When you have a narrow opening range, that usually leads to breakout behavior. So keep that in mind when you use the opening range breakout entry. Now here's a last slide that shows you all the various ways that you can use this entry. Because remember, now that we have our retest entry, we have our ambush entry, and we have our threshold entry, we can use those in combination to trigger. So you're triggering an entry within an entry. So here's the 30-minute range, and say we're going short, opening 30-minute range. Boom, we break down. Your stop market order here is ready to be filled. So right there, that is an opening 30-minute range breakout, right? But you're also using the stop market order just beyond that level. That makes it a threshold entry, right? That's the first way to use it. So you're combining threshold entry with 30-minute opening range. Number two, the second way you can use this is by requiring that price close outside of that range first, because a close outside the 30-minute range offers additional confirmation that price is indeed likely to continue in that direction. Doesn't guarantee it, but it provides additional confirmation. So this is an additional confirmation approach, is that you require price to close outside of the range, and then you trigger your entry there. The third way that you can do this, and this is the preferred method that I use, is that when price does close here, outside the range, I put my retest entry at the center of that candlestick. And when price comes back, I get filled here, and now I'm inside the range at a better trade location ahead of the potential down move. That's my preferred method. Now, that's what I do every single time. Price closes, I want to be short. So I put my retest entry at the center of that candle and I let price come to me to get filled. A lot of times I am filled. It may take 1, 2, 3, 4 candles to get filled, so I'm waiting 20 minutes sometimes to get filled. But you know what? I do get filled and I get a great entry. If price does not come back to fill that entry though, I scrap that limit order and then I wait for price to come back to retest the 30-minute low. So price comes down, and on that first pullback, what the market is doing is it's retesting the opening 30-minute range. Are there any buyers that want to come aboard? No, instead there are sellers. That's your point to get short. So I place an ambush entry. If price gets away from me and never fills that order, I put an ambush entry right at the 30-minute low, and I just leave it there. And if price comes back to test it, I get filled, and now I'm in here ahead of the move. Those two, numbers 3 and 4, are my preferred style entries. All right, let's talk about the opening range reversal entry. The opening range reversal entry basically allows you to enter the market based on the opening 30-minute range, but it's a reversal entry. So instead of, if this is a long position, instead of opening upon or entering the market upon a break through the top of that range, wait for price to come down to the opening range low, have a retest or an ambush entry ready to go at that zone, and then trigger here ahead of a potential rally. This is a medium to high risk factor, and you have to be very confident that this support zone is going to hold or that the market is going to maintain a bullish stance. You have to be confident. So I put medium risk factor here. I actually might say that that is a medium to high or high risk factor because you have to be very confident because again you're using ambush order, which you have to have a high confidence factor in, and you also have to be confident that that support level is going to hold and the market's going to maintain its stance. So let's look at some examples here. In this example, we have an up move going on. We have a big severe pullback, but right here we got a very nice full-bodied candlestick, and then the next day we gap open. We get a nice gap up, and on this gap you saw this support level, you saw this pullback, you're eyeing it as a potential buy opportunity, but then price gaps up. You don't want the train to miss you, so you drill down into the intraday chart and you try to get an opening range entry, either with a breakout or a reversal. In this case, price gaps up, and immediately you see an open drive opening relationship. An open drive relationship means price opens and immediately continues to go in that direction of the gap without looking back. That's an open drive relationship. About as bullish as you can get, the most bullish you can get, as a matter of fact. Well, when that happens, you usually get a snapback, first of all. And when you get that snapback, you want to see that low hold, and that becomes your 30-minute low. And look how it became support the rest of the session. It doesn't always happen that way, but when that does happen and the gap integrity remains intact, put your ambush entry somewhere on this line, anywhere, or do a retest entry. So when price tests through it like this, put your retest entry somewhere inside that wick and see if you get filled. Either way, just get filled on this reversal point, anywhere on this line. And then when you do, you can see you get a great entry, and you're getting that entry at the beginning of what could be a very nice multi-day or multi-week move because it was a breakaway gap after a reversal. Here's another open range reversal entry, and Again, I want to show you the various ways you can use this. This isn't being a robot and just trying to figure out, okay, this has to be done this way or this has to be done this way. I'm giving you all the various tools and techniques and put them together. Be able to know the information so well that you can just put them together in any combination and way. It's like Legos. I have a 4-year-old daughter right now, and I play Legos with her every single day. And every single day I challenge myself to make something cooler and cooler because I know how the Legos can be put together, but there are endless combinations of how you can put those things together to make something amazing. That's the same thing here. You have a bunch of great entry techniques. You just have to know when to use them and how to use them well. In this case, we're bullish for whatever reason. The market opens up and builds the 30-minute range. That's the low, that's the high of the opening 30-minute range. 1, 2, 3, 4, 5, 6 5-minute bars makes 30 minutes, right? And then when price drops down into this zone, you can place an ambush entry at the 30-minute low. You're in here. Again, that's a very high risk factor, and you have to have a lot of confidence to use that entry. If you don't, use the retest entry. You let this bar test, and when it's a successful, beautiful test, like it was, this is a Dragonfly Doji, beautiful, beautiful reversal pattern. I put my retest entry at the center of that candle, and I get filled to the tick almost ahead of the move. Or, if you don't get that test, use the threshold upon a crossing of that Dragonfly Doji. You're in here now. So you're either in here, here, or here. But you're not chasing the trade. What too many novice traders do, inconsistently profitable traders, is they need a lot of confirmation here. And when price starts to go here, 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 this is when they're getting in. Here, or there. You potentially can get in here or there. Those are amazing entries. Just know how to use them and know how to put the puzzle pieces together to get that entry. Start with an ambush if you have a high confidence factor. If not, use the retest. This one will trigger most of the time. If not, and you're afraid of getting it, price is getting away from your entry, use the threshold and you're in here. And now you can just sit back and wait. Lastly, let's talk about the VA reversal entry. The VA reversal entry is the value area reversal entry. And this value area, you know I teach a lot of value area concepts, pivot range concepts, market profile level concepts, even Camarilla equation value area concepts. I am a firm believer in the value area. Every time frame has a value area. Every single time frame has value area. And if you can identify those areas, you can identify where the market is likely to test when it wants to retest value. And a successful test will lead to a great buy the dip or sell the rip opportunity. This is a medium risk factor again because there's not a lot of low risk entry factors when it comes to trading. But this is a medium risk. I mean, it's pretty decent. It's medium to low risk entry, especially if you're in an established markup or markdown phase. And if you have the value area, so this is the pivot range. This is what we learned in part 1 of this course. The pivot range is completely higher than the prior day's pivot range. You have a higher value relationship. When you have that relationship, let price come into you, into the test zone, which is the pivot range, and if buyers successfully defend that zone as they should, you can get your entry into that next wave of movement. Let's look at some examples. First, I want to show you the ideal rules for entry when it comes to this type of entry. Number 1, the pivot range must be completely higher than the prior day's pivot range. 1, 2, 3, this range is higher than 1, 2, 3, this range. You see right here? Completely higher. That's good. Number 2, the prior day's close is above the next day's pivot range. So this day closed higher than the upcoming day's projected pivot range. Now, how do you know that? Well, I've written an indicator that will tell me where these levels will be the upcoming day before the day opens. Or you can open up your spreadsheet, put in the levels of what the high, the low, and the close of this day, And the equation will tell you where those levels are going to be the next day. So this is above the pivot range. Number 3, the current day's open is above the pivot range. Boom, this day opens the day above the pivot range. That allows you to have some momentum where price will drop into the pivot range. You always want price to drop into the pivot range after opening above it, because if it does, that's the retest that the market needs, the reassurance, in order to have further upside price discovery. You have to know the psychology behind these moves. If the market is trending up and we want to get long, if the market opens up, it's already opening bullish. If the market closed up, it's already bullish. Now, when the market drops into this range, it's doing so to retest prior value, and if that test passes, if buyers, responsive buyers, defend that zone, that's all the reassurance the market needs in order to see upside price discovery. And number 4, use any pro style entry upon a retest inside the zone. This one happened to come and form a dragonfly doji right there. So you have to be quick and put your retest entry right at the center. You would have gotten filled right here, or you put your stop market order here ahead of the wave. If you miss this and you have these two right here, put your retest entry at the center of this range, and now you filled here, right? So it doesn't have to be perfect, but always expect a better entry than not. Now, when we're talking about value area reversals, I want you to see this differently. This is a very important section, and I think it's going to open your eyes to how to view the market. This is the value area reversal structure. This is what it looks like when the market is trending up. This is a daily bar. This is day 1, day 2, day 3, day 4, day 5. These are daily bars. But you see the shaded areas? See these shaded areas here? There's none here, and then a shaded area here. These are the areas where price in the upcoming day retests price levels within the prior day's range. And if that test holds, you see a move up. And then it comes back to retest the price levels from the prior day. And if that test holds, you get a move up. Essentially, what's happening here is you're forming a trend. And your goal is to buy the dips. This is the low, this is the high. There's a new high. What do you have in trending markets? In a bullish trend, you have new highs, then you have a higher low, then a new high, then a higher low, then a new high, then a higher low, then a new high, higher low, new high. Your goal every time you trigger an entry is to trigger on the pullback. You're trying to trigger on the wick here. You're trying to trigger in the wick here. This one doesn't have a wick, but this one does, and you're trying to trigger here. So instead of being mad that you missed this huge move, place your limit entry at the center of this range to capture the pullback. And then you get triggered on the pullback test ahead of a new high. That's what you have to do. I'm going to break it down into some X-ray vision for you now. Look at this diagram. This is a different 5-day up move. Day 1, day 2, day 3, day 4 is a doji, day 5. This is the intraday price bars that developed to create this candle. You can see here, it opened here, that's the open, then price dropped here, forming a low, then it rallied to the close here. This is the wick. Then price opened here, dropped into the prior day's range to test. The test was successful and confirmed, and then we get a rally to the close here. And then the market opened here and retested the prior day's price range. Confirmed test, go higher. This one was a crazy doji day. Nonetheless, when price dropped here, held its support, rallied, etc. And then here, it just formed a bullish day. So when you're looking at this, you're looking to trigger here. That's why I say, if you have a nice bullish candle here and you want to get long, put it at the center of the range. When market comes back to retest it, you're going to fill at the bottom of this candle, and now you're in ahead of the move. You want to fill here. This is your buy the dip opportunity. So let's look at an actual example. Again, we have an uptrending market, Something's bullish. This is an inside day value setup, right? Inside value setup. We'll talk about this setup later. Pivot range inside the prior day's pivot range, we get the gap up and a nice move. Hey, we missed that move for whatever reason maybe, but I want to get in long. Well, here's the value area. Price closed here, price opens above it, price drops into the value area. Whatever it does, it does. Just finding a way to get in somewhere in here, and then you're long. And then if you want to get in over here, price closed above it, price opens above it, price drops into the pivot range for another test. The test is good, and then it goes higher. Just like we saw in the prior chart, in the prior diagrams, a new high, a higher low, a new high, a higher low, a new high. Most traders are triggering on new highs. You need to trigger on the higher lows, here and here. So if we have an overlay right now, this is what it looks like. You see this big bullish candle? This is the actual candle for this day. Boom, big bullish candle. Okay, I'm going to put my entry at the center of this candlestick. Okay, that's my retest limit. And the next day, it drops right into it, fills it on the wick, and now you're long. That's what you want to see. That's why a retest entry is so powerful when you're trading in daily bars. If this is a daily bar and we were only looking at daily charts, put your retest entry at the center of that bar, boom, you're getting filled, and then you go. This is the same thing, only instead you're dropping into a 5 or 15-minute chart, you're looking at the value area, and you want price to come down, test the value area, and hold the value area, and if it does, get long. It's just another way to do the retest entry in a daily chart. Does that make sense? Because this is huge. If you can visualize what I've just shown you over the last 4 slides, you can begin to connect the dots when it comes to triggering entries in any time frame. All right, let's look at this now. This is the VA reversal example, and we saw this example earlier when we used an opening range reversal. This time we're going to do a value area reversal. This is the breakout bar right here. This is an inside day. We got the breakout to the downside. Remember I showed you how to enter this bar using the opening range 30-minute breakout reversal. Well, say we missed that, and now we want to get in. What did I tell you? Here's the high and the low. Put your entry at the center of that range as a retest entry. You're going to either get filled or barely not get filled. It's right in that zone, right in the 60.10, 60.20 zone is where you want to be filled, okay? Your goal is to fill on this wick part of the upcoming candle. This has not happened yet, but your goal is to fill right here. So now we look at the next day. Here's the breakout. This is the bearish bar. This bearish bar is this price activity here, plus the activity we don't see over here. Lower value relationship the next day. Price closed below it. Price opens below it. And that first rally into it, right here, that's a zone that you need to consider for shorting. That is this part right here. See, price opened with a gap down. Here's the gap down. Then what does price do? Immediately rally for a retest of the prior day's range. If that test passes, then you drop to new lows. Here's the retest of that zone. Remember I told you between 60.10 and 60.20, right in this zone. Boom, 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 boom. Anywhere. It doesn't matter where you get in. Find a spot in this zone. And then use one of your pro-style entry techniques to trigger a great entry. And now you're in ahead of that multi-day swing move. And now that we've covered the pro-style entry techniques, we're going to now look at actual swing trading setups. We're going to start swing trading setup section. Indicator-based setups, candlestick setups, and range-based setups. We're going to use 3 styles of setups here because I'm opening your eyes to the types of styles of setups that you can do. You know, you can be strictly based on indicators. You have to use good indicators and the indicators that I've taught before. You can do pure candlestick setups. or you can actually do average price range setups. And we're going to look at each of these, how to use them, when to use them, and the nuances behind using them successfully. So we're going to start this setup section with the indicator-based setups. The indicator-based setups are those setups that are designed to keep you disciplined to the overall trend while pointing out the value opportunities along the way. Setups like the PIMA pullback, the inside value, VWAP pullback, and higher and lower value setups. For the most part, these setups are all setups that are designed to help you identify pullback opportunities or value opportunities within established trending phases. The inside value is the one that helps you identify a potential spark to a new markup or markdown phase from the accumulation or distribution phase. So we're going to start with the PIMA pullback. The PIMA pullback setup is used to identify value opportunities during trending markets using pivot-based moving averages. I talked about those pivot-based moving averages in part 1 of this course, and you know that there are 3 intensity levels that I talk about. There is the high intensity, 8, 13, 21, the medium intensity, which is the 13, 21, 34, and of course you have the low intensity, 13, 34, 55, which is my catch-all as well. This is the one I use all the time unless the market dictates otherwise. 13, 34, 55. The long period moving average here is the overall trending moving average, and the period between 13 and 34 is the trigger zone. When price drops into the trigger zone during a very nice markup or markdown phase, that is the trigger zone to get long or short. This bar right here is the trigger bar. This bars 1, 2, 3 are the subsequent move that you'll be participating in because you triggered a great entry. Now, every single one of these setups, unless talked about otherwise, should be used during an established markup or markdown phase. It has to be an established phase, preferably a phase that came out of a period of accumulation or distribution. Look at this phase of accumulation. Remember what I told you in part 1? The market needs an accumulation phase to fuel a great markup phase. This is the fuel for this move. So if you can identify those types of markup and markdown phases, you'll do a lot better for triggering great entries using these setups. Oftentimes, the safest way to get the best trade location is to allow price to test the trigger zone first. If you have a nice bullish candlestick, a candlestick that you can feel confident is a reversal candlestick from that trigger zone, then you have all the information you need in order to place an entry. For example, this bar right here is about as good a wick as you can get. I mean, price opens above the trigger zone, drops into the trigger zone, finds buyers immediately, and closes back above the trigger zone. That's a great, great bar. I have a high confidence factor that that is going to lead to more strength. So I place my retest entry at the center of that candlestick, get filled on that limit order at a great entry, and then price moves up. That is exactly what you want to see. That is almost the perfect entry and the perfect setup for that phase of the market. So here's another one that looks just like it. Again, the PIMA pullback, 1, 2, 3. The moving averages are stacked and sloped. That's what you want to see. Stacked. The fast moving average is above the middle moving average. The middle moving average is above the lagging moving average. Stacked. Sloped means they're trending higher at, 45 degrees would be the best. It's not always that way, but they're trending higher at a very nice degree that indicates strength. When price tests into the trigger zone and forms a very nice reversal candlestick, place your retest entry at the center of that wick and get filled on the next entry, on the next candlestick. Boom, you're in here ahead of the move up. Very, very nice. Again, an established markup phase. This one is on the second wave after the breakout. Here's a phase of accumulation, kind of a coiled pattern. Once we got the break up, we came back for the initial first test. That first test held and ran to a new high. Right there, that structure indicates that we're likely starting a very nice markup phase. So on that first pullback, you can see price dropped right into that trigger zone. Again, buyers led to the formation of a wick at the tail end of that candlestick. That's a great, nice entry to potentially get. So you stick your retest entry at the center of that wick right here and get filled right toward the bottom of the next day's candle ahead of a big move up from 104 to 114. And if you blow it up, you can see it right here. You form this bar. Here's your wick. That's the center of the wick. Let's place our retest entry here. When price opens the next day, drops down, fills, closes back above, and now we're in at a great trade location. But it's all about letting price test the trigger zone first. Don't be a hero. Don't be a hero and say, I'm predicting price will exactly reverse right here, or exactly reverse right here and put an ambush entry. Don't do that. Instead, let price test it. Let price jump into that zone and see what the market does. When you see that there's bullish activity, responsive buyers defending that zone, and we're likely in a new markup phase, let the market give you the information you need and then place a great entry based on that information. Even if you miss a trade because it didn't come back, you can always participate in the move by triggering another trade. So for example, right here, we formed a very bullish bar right at the trigger zone. That is not a good way to trigger an entry short. You don't want a ginormous bull bar, right? Instead, you want a wicky reversal bar or, some other type of weak bearish bar. So if I was trading this here, I would be waiting for additional confirmation to try and trigger that short entry. Well, price gapped down instead. And when price gapped down, it formed a bearish wick here. So I didn't quite get that perfect entry. But now I basically feel confirmed that we're going to drop down lower. So instead, I place a retest entry at the center of this candlestick, and now I'm filled here instead. I didn't quite get the perfect entry here, but I got the perfect entry for the move that happened. Say you didn't get filled on this candlestick either. Well, put your stop market order below this candlestick and get that last ditch short entry. That can work as well. Same thing over here. If price rallies into this level and somehow you did not get filled here, so you put your retest entry right at the center of this range. Again, you didn't get filled. So put your stop market order right here and get filled on the breakdown. That can happen as well. Or put your retest entry here at the center of this small-bodied candle, and you get filled on this wick ahead of the move down. You can always find a way to get a great entry, even if it's not the best, most perfect entry that you are hoping for. Now, when we're looking at the VWAP pullback setup, this is very similar to the PIMA pullback setup, only this one uses volume-weighted average price. But the general rules remain the same. You're looking for value opportunities. You're looking for a trend confirmed phase, a markdown or markdown phase. And when you get that nice pullback into the trigger zone, you're looking to trigger an ambush or retest entry at that zone as close to VWAP as possible. When you can get that type of entry, you're going to get a great entry in the direction of the move. So here we're looking at VWAP. And the first example we see is one that has gotten the first major test after establishing a new markup phase. Here's VWAP building out. VWAP builds out, and this is the initial line, right? So at the beginning part of this development, we're not really using it for trade ideas yet. Let it continue to build out. Now that it has a basis, when you see a pullback into that zone, you can trigger that first bounce opportunity. That is what you want to do during established markup or markdown phases. Now this one's a tricky one, and you're going to encounter tricky entries along the way. But when you see this drop into VWAP, it's a very bearish rollover, boom, boom, a big gap down. And then look at this wick tail and then a close right at VWAP. That's about as bearish a bar as you can get. So take this one, this one, this one, this one, this one. Take these 5 bars off your screen, put your finger there, and only look at this red bar. If that's the right edge, that looks very bearish, and I am not excited about triggering that entry. So I won't. I want to see more price activity around that level so that I can know how to enter that trade. Well, look at the next bar. Opens a little below and thrust higher very nicely. Okay, now we're getting signs of a reversal. Oh, look down. Wow, look at that volume that entered on that bar. Very nice, where the volume is confirming a potential reversal off that zone. So now that you see that we've gotten that nice test, you can be more confident in placing a limit order at the center of this bullish bar and getting filled the next day, right here. Again, right near the low of the day ahead of a big bounce up. Let's look at this VWAP pullback example. Right here, you actually have a very similar case to what we just saw. And they should always be similar cases. They should always look similar to each other because you should always trade stocks or instruments that are basically moving in a very nice, well-structured, well-behaved manner. And if you have an established markup or markdown phase, then that will help you trigger these entries much more cleanly than if you were triggering entries in some type of volatile stock or trading range crazy volatility type stock. So right here, again, you don't have to be a hero and place an ambush right at VWAP. You can. I do sometimes. I don't think I'm a hero. I'm a little nervous, as anybody should be nervous with that type of entry. You should have some type of nervous factor when you're using an ambush entry because that keeps you on your toes, it keeps you balanced, it keeps you with an eye toward risk. But in this case, price drops right down. We see the bullish reversal potential because of the candlestick, the way it developed. You put your limit order at the center of the next candle, or that wick, and you're filled on the next candle. When you're filled, you get in ahead of the nice move. And then later on, you get another test at that zone. Again, a very bearish move here. I'm not looking forward to triggering after a huge bear candle like that. But then you get another thrusting candle, similar to what we saw on the last slide. Once you get that thrusting candle, put your entry trigger at the center of that candlestick. And you may not be filled here. You may not be filled on this second day. Maybe you're filled on the third day, but you're going to get filled at a great entry ahead of the move. That's the goal. That's the idea. Here's another example. And this is what I often do. Again, accumulation phase, markup phase. This established markup phase makes it like shooting pullbacks in a barrel. Boom, boom, right? So when price drops into this zone, look at this beautiful wick that forms. It's not perfect because you have the wick on the top side, but below, from VWAP below, buyers swarmed and said, you know what, this is too cheap a value. We want in ahead of the next move. Well, what do? I place my retest entry at the center of that wick. That's what I do. You can see I did not get filled. But that's okay. You're not always going to get filled, but at least you tried. If you don't try, you don't get the great entries. I tried to get filled here. I did not. So I moved my stop market a little higher. I mean, my limit order a little higher and a little higher until I do get filled. So in this case, I don't want to move it any farther past VWAP, but I'll move it to VWAP. And you can see the low of this candle and the low of the second candle both came at VWAP. I'm in at the low ahead of the move. So start ambitiously. Put your limit way down there, somewhere crazy. This isn't even crazy. But just put it out there and see what happens. If you get filled, you get a great entry, trust me. If you don't, then continue to massage that entry until you do get filled. Here's a VWAP pullback example in staples. Again, in a daily chart, you have a downtrending issue here. You can see VWAP very nicely building out. This test led to weakness. This test led to weakness. Price didn't even get back to it here before it dropped. What's your goal? Your goal is always to place an entry as close to VWAP as possible, if not beyond. If I'm very confident that we're going to get a reversal from VWAP because that's what's been happening and that's the structure, the current structure of the market, then this is what I do. Typically, I put an ambush entry beyond VWAP because look how far beyond it came here before it dropped. But I know it's in a downtrend. I know it's in a downtrend. So I'll put my ambush entry somewhere beyond VWAP and hopefully it comes up and fills me. If it doesn't, then I move my limit entry back to or toward VWAP and get filled there as an ambush. Even if I miss that ambush, I can always go to the retest phase. And if I do the retest entry on the next bar and still don't get filled, well, you know what? I still have my stop market to help me. So I use the threshold entry here. So you can always go through your progression of entry techniques in order to get your fill. If price does not, if I'm too slow and I don't get filled on the stop market here, then you know what? I'm either moving on to the next one or I'm going to keep, I can place a limit order back at that zone. So if the price does come back and test that zone, I can get filled where I should have been filled to begin with. So there's a whole lot of different ways that you can do this. But always look for the best entry. That's the key. Here's VWAP pullback for target. And you can see here that we have a bullish candle right at VWAP. I mean, it's right on the button. You know, because you had that reversal here, and because that was also a breakout point over here, you could potentially put your ambush entry right at VWAP and be filled. But again, you don't have to be the hero. Instead, let price test that zone and see what happens. When you get that bullish reversal candlestick, put it in the middle of the wick, get filled on the next bar, and you still get a great entry that's more confirmed and that has a lower risk associated with it. Now let's talk about the inside value setup. Those of you that have read my book, that have read my analysis on my website, that have read anything I've done or any of the other courses I've talked about, you know about the inside value setup. I don't often teach it in a daily style time frame or for swing trading only because it can be used in any time frame, but this one is specifically we're talking about swing trading. So this is the pivot range. This is a monthly pivot range, and you want the upcoming month's pivot range to be rather narrow and inside the prior month's pivot range. You want this development here to lead to a potential breakout opportunity from a phase of either accumulation or distribution, because that's like the, shooting the gun to start the race. That's when you know the race is on. If you can get a gap out of that range to begin that new month, or to get a gap out of that setup, then you could start a very nice period of markup or markdown trading activity. So let's look at some examples here. Here's a phase of accumulation. We have the pivot range here. The next month's range is very narrow. Look how narrow that is. As you know, narrow pivot ranges or narrow value areas in general typically lead to range expansion, whereas wider pivot ranges or wider value areas lead to range contraction or compression. This inside value relationship helped us identify a potential breakout opportunity. The gap confirmed it. Look at the gap occurred outside of the range. That's great. Now you can either get in on the first day, or you can let the first day play out and then use a retest entry. Remember, my retest entry is the one I use for most every entry that I take. So you let this first day play out. Here's your retest entry. Boom, you're filled right here, and then you continue higher. Now, this has a nice wick on the top, and that's not my favorite. As a matter of fact, I usually avoid that style entry. But this body on the bottom is equally as big and is very green, very bullish. And you have a very nice influx of volume. The gap integrity remained bullish. That's why I'm comfortable putting a retest entry here. But if I wasn't, you would put a stop market order here, right? And then get filled up here. And that's not ideal. I mean, I usually wouldn't put a stop market order way above a wick that way or too far away from current price. So this is usually the best approach. And you can see it worked here. Here's another inside value relationship. Look at the month of January. 1, 2, 3. This pivot range is inside the prior pivot range, and the pivot range is more narrow than usual. Again, that leads to typically explosive breakout behavior and range expansion. This one right here, nice gap up, almost fully out of the range. But again, not the most bullish candlestick setup, right? The gap integrity remained true, but not the most bullish. So in this case, use a stop market order when price breaks through that zone, more confirmed entry, and it's just a better approach to trading this after this opening relationship here. Now, of course, I mentioned before that even if you have this setup, it's best to have this setup occur within the confines of compression or contraction, range contraction, an accumulation or distribution phase. And you can see right here we have a couple of months of very quiet trading activity within the range. We formed an inside value here and got a breakout that failed back here. And then we got the inside value here and a gap up that held the gap integrity there. After that, you can either put your retest entry at the center of this range, not get it because you know the market's going to open here. Well, then put your stop market order here and get filled there. Or use an opening range entry inside, or an opening range, breakout or reversal on the second day or on the first day. It doesn't matter. Just find a way to get in that trade and do it in the most responsible way possible. Now let's talk about the higher and lower value setup. Basically, we have higher value here and here. This is the pivot range, but it could also be market profile levels like value area high, value area low. It could also be the Camarilla equation levels like H3 and L3. I like the pivot range. I like market profile. I like them all. You can use this idea for any type of indicator that provides some sort of value area to you. Value area is completely higher than the prior, and price hopefully closes above it, opens above it, and drops into it. When that happens, look for a way to get into that trade. But you have to remember, this development here has to occur within a markup or markdown phase. It has to be a clear trending phase. If it's not, it can still work, but it's not as confirmed an opportunity. Again, let's look at the ideal rules for entering this style entry. The exact same rules as the intraday version, but instead we're using the prior month and the current month's pivot range. So the current pivot range for the month is completely higher than the prior month's pivot range, which is here. That's number one. Check. Prior month's close is above the next month's pivot range. This was the close for the month. This is the pivot range for the upcoming month. Check. Current month's open is above the pivot range. Price opens the month here above this pivot range. Check. Now use any pro style entry within the pivot range. Price moves down into the pivot range, finds buyers. You see a beautiful tail here. Put your retest entry at the center of that wick and you get filled at a great entry and you get a very nice follow through. Those are the ideal rules for entering. If price had not closed here above it and closed down here below it instead, it's a completely different ball game. It's telling you that even though price, the pivot range is above, the market is already discounting that and potentially moving lower. If price had closed here, but instead of the gapping up and gap down here, again, that's the market telling you that something's wrong and we're probably headed lower. So opening above and closing above are very important. You have to have this type of move into the pivot range in order to find those buyers, because what does price do? Auction market theory that we talked about. Auction market theory that we talked about in part 1 of this course says price will auction lower in search of buyers. That's what it's doing. It's auctioning lower, and when it finds buyers, enough buyers down there in the value area to defend that zone, that's all it needs before it can see upside price discovery. That's what it's doing. Let's look at another higher value entry here. This slide basically says that there are a million ways to enter a market. A million ways to enter. I've shown you 6 different ways to enter a market with both intraday and end of day techniques and combinations of those techniques. This is what you see here. Here's a clear markup phase, higher value, higher value. Price is dropping into the zone. Well, right here, you can put a retest entry at the center of that wick and get filled here. Or, if you don't like that entry and you want price to drop into the range some more, then you wait for this candle to build out, and then you hit a stop market entry, a threshold entry above a break of that zone. Okay, you can do that. Well, maybe you missed this and price goes way up here, and you say, you know what, if price comes back to the pivot range, I want to get filled here. So you place an ambush here, and price drops down into that zone and fills you here. It's endless possibilities. Look at price dropping here, forming an indecisive candlestick there. Well, put a stop market order above it and get it filled upon a break of that high. What about this one? Outside day candlestick, very bullish thrusting pattern from the pivot range. All right, well, you know you can't really get in on a thrusting engulfing pattern, so instead what you do is put your retest entry here. Well, now you see the market's actually going to gap up, so you're not going to get filled there, so you play the opening range breakout or opening range reversal and enter in here, right? What about over here? Price drops down, no great wicks to talk about, so you use a stop market order. Or you wait until this bullish candle develops, and then you put a limit order at the center of that range and get filled here. You see what I'm saying? The opportunities and the possibilities that you can do begin to just open up once you understand the techniques and how you can use them and implement them. Here's a lower value example. Clear downtrend, so it's a markdown phase. Price rallies into, remember, we sell the rallies in a downtrend. The rallies into the pivot range. This is where you find it. Now, you see this indecisive candle that forms after the big one, right at the center of the pivot range? Yeah, that's kind of bearish. So you put your limit entry here. The next day, price gaps down, rallies up, fills your entry. You're in at the tippy top of that move. What about over here? Same thing. Price rallies into the pivot range and then drops immediately. You missed the move. But you know what? You can put your limit order at the center of this range and try to get it to fill a day or 2 or 3 from now. And look, it actually fills 2 days later, and then you're in at the tippy top of that move on the way down. Always try to get the best trade location, even if you don't get filled, because you can always get filled later, or you can always go to another stock and get filled over there. It's not the only game in town. Now let's talk about candlestick setups. Candlestick setups are some of my favorite setups. They're the first setups I really learned when I began trading a long time ago. Seems like a long time ago. And I learned every single candlestick imaginable. And then I learned that you have to be able to pair them correctly and know when to use them. With any of these setups that I'm talking about, we're covering a whole lot of setups. Candlestick setups, range-based setups, and indicator-based setups. This is an important point to note. It's not the setup that makes the money. It's the ability to know when to deploy the setup that makes the money. And nowhere is that more important than when you're talking about candlestick setups. Candlestick setups are very simple and effective at helping you identify potential opportunities, but you have to use them at the appropriate times. The three that we're going to talk about are the inside day, the outside day, and the gap play. These three can help you identify some pretty decent moves in the market. And if you use them at the right times and know how to enter them, you're going to do quite well using these. Let's start with the inside day setup. The inside day setup develops when the current day's price range falls completely within the price range of the prior day's trading range. So you can see here the setup is fuchsia. This high, this low falls completely within the high and the low of the prior candlestick. That tells you that the market is coiling and is likely due for a potential breakout. It's best to identify and trade this setup when it's in the flow of normal trading behavior, not within a congestion. The best way to trade this setup is to use a stop market order beyond the 2-day high or the 1-day high, depending upon how far they are from each other. Stop market entry here and you get in on the breakout. Or you can use the opening range technique, like opening range reversal, opening range breakout, in order to trigger that entry. And I'll show you some of these examples here in a moment. Here's one. Inside day relationship. High and low are inside the high and low of the prior day. But look, we're also forming this candlestick pattern within a PIMA trigger zone. 1, 2, 3 moving averages, 13, 34, 55. We're in a markup phase. Price pulls back into the trigger zone, forms an inside day candlestick, and the next day, what happens? We gap up beyond that zone. That's a great case scenario when you gap out of prior day's range and value, because that tells you the market is eager to get going. Initiative participants are ready to move price to new value. So when price gaps up, obviously you can't put your stop market order here anymore, right? Because we gapped above it. So instead, what do? Well, time to use an opening range relationship, or opening range reversal or breakout. Which one is it? Well, let's drop down into the 5-minute chart. This is the exact same inside day relationship that we were looking at the last chart. Here it is on the daily chart. Inside here, we gap open. That's the gap here. We drop down initially, find buyers, and then rally up to form the 30-minute range. That's a great case scenario. Buyers defended the integrity of the gap. That's great. That's this wick right here. So what do? Well, you can put a stop market order here to fill an opening range breakout, or you can wait for price to come back to the 30-minute opening range low to trigger an opening range reversal. Now, there's never a guarantee that price will actually do that, so price could actually leave you behind and you can never trigger that entry. That's completely fine. I am never worried about price leaving me behind because I know there are countless opportunities on the market that I can take advantage of. Well, what happens here where a stop market order, say somehow it didn't fill for you because maybe it was too late to get in there, and now, or you were requiring a close above and then you were trying to do my technique where price comes back into the range and you fill a limit reversal. It just doesn't happen. Well, in that case, I put an ambush entry back at the 30-minute opening range high. And when price drops back into that 30-minute opening range high, my limit order for an ambush entry is there, ready to fill. I'm in, and now I'm in that move. All right, what about this one? Here's another inside day relationship, and this is a good one because what this shows is the inside day portion here is very narrow. And when it's very narrow, that gives you further notion that it's coiling up ready for that breakout. It's also happening in the midst of an up move, right? The other thing is there's many ways to trigger it. Here's a 2-day high that you can trigger. and you put your stop market order right at that 2-day high. And when price breaks through that zone, you have a stop market order ready to trigger. That's your threshold entry, and you trigger it, right? Or you let price open, and then you do an opening range entry or a value area entry. All right, this chart right here is very important because it shows you that placement of these setups means everything. Where a setup develops can tell a lot about its potential success. You can see right here, this is an inside day relationship, but it formed inside the muck of the first month of the trading year. Basically, price opened with a big gap up and went nowhere for a month. Okay? Inside that range, you're having an inside day relationship. I am not confident that that's going anywhere. But over here, the inside day formed in the midst of a down move. That is better, right? When it forms in the midst of normal trading range behavior or trading activity, market structure, that's when it works. And then you can place your your threshold entry right here, get filled here. Or if you miss that entry, you can put your retest entry here and get filled there. Either way, you can do a lot of things to get in, but just know when to identify these at the right spots, because that goes a long way toward telling you if your setup's going to work out. All right, let's talk about the outside day setup. The outside day setup develops when the current day's price range completely engulfs the prior day's price range. This signals an impending reversal. Now, I look at an outside day a little differently than traditional candlestick experts. Basically, I want the outside day to have a low that's lower than the prior day's low and a close that's higher than the prior day's high. That makes an engulfing pattern that is super strong to me. I think traditional candlestick experts want the body to engulf the prior day's body. I'm concerned about highs and lows and bodies and closes as well. I'm concerned about it all. Because if you have a low that's lower than the prior day's low, that means the market did try to test levels below there. But the market was so strong that it pushed price higher, and not only higher, but so high that it broke and closed beyond the prior day's high. That is when you know you got a great thrusting candlestick pattern. That's an outside day setup. Now, when you have this setup, it's very difficult to get in on the next bar, on the current bar. I mean, because the magic has happened, it's difficult to get in on this bar. So what you do is you put a retest entry at the center of that bar, and hopefully you get filled the next day. If you don't, then use a threshold entry to fill upon a break of that bar. That is the approach to this setup. But again, where this setup develops in the midst of the overall price structure of that trade will make a lot of sense in terms of, will that setup succeed or fail? It has to be at the appropriate point in the chart. For example, here's a great well-defined support zone. Here's an outside day reversal, lower than the prior day's low, closes well above the prior day's high. That sparked a huge move. Then you get a dragonfly doji at that reversal, at that support again, and boom. Now when price drops down again, look what happens. A low below the prior day's low and a close above the prior day's high. Again, confirmed at that support level. Very good move up. But look at this one. At resistance, and then you have a bullish outside day. You know, anywhere else, this would look super bullish. But the fact that it's at resistance, that's a premium that I don't want to pay. Now, that doesn't mean that we can't see continued strength through the top. That just means I'm not willing to trade that setup there, because it's not great trade location overall. It's not great placement in the overall price structure of that current chart. It's just not there. And that's what you should learn. If you take anything away from this course, it's trade what makes sense, trade what you're comfortable trading, and you do not have to trade. You don't have to trade. You can sit on your hands because oftentimes that is the best approach, especially when you consider that most traders lose money. If most traders lose money, stop trading so much and only trade the best possible opportunities. Not every opportunity is perfect. But you know what? If you only trigger those opportunities that look perfect and trigger great entries and get great trade location, you're more likely than not to have great trades. You just have to have the patience and the discipline to only trade when the best opportunities are present. Let's look at this outside day example. Beautiful example. I love this example. 1, 2, 3. This is the PIMA pullback. You got stacked and slope relationship here. The bottom held as support. Price drops into that zone and forms that outside day candlestick pattern, and then we gap up out of that range. Right there, that tells you that that is going to be a very bullish move. As a matter of fact, if you look for this candle right here to form, many times, I'd say a high percentage of the time, if price gaps up in the next day, that combination of this outside day along with the breakaway gap leads to big moves more often than not. That's another little setup within the setup. This, I know, is very bullish. Outside day thrusting pattern, initiative participants continued to work that money overnight. We got a gap up. Now, use an opening range relationship to get in that trade somehow. And when you do, you're going to be rewarded. But it's all about placement. This candlestick pattern happened at the right place in the trigger zone of an overall markup period. That's bullish. If this candlestick had formed up here, you know what? It still could be bullish, but I'm not trading it. It's not the right spot. What about here? Markdown phase, lower value along the way, a lower high here. Look at this, drop down, pull back, lower high at the pivot range, and then you form this outside reversal candlestick. That is super, super bearish. What do? You know what? I want to put my retest entry right here at the center of this range, at the center of this candlestick. If I'm not filled, then I'm going to try and get in with a threshold entry or an open and range entry the next day. But I want to be in that move because I know this is coming right here. All right, let's talk about our last candlestick setup, and this is the gap play. The gap play looks to profit from momentum opportunities that occur when price gaps out of a phase of accumulation or distribution. That's important. This is not just any gap play. It's just not any gap. It's not any breakaway gap from any price structure. It's a gap that breaks out of an accumulation or distribution phase, because that can trigger the beginning of the next markup or markdown phase. And if you can get in at the beginning of what you know will become a markup or markdown phase, then not only do you have a great swing trade on your hands, but you have a potential position trade that could last months. So the gap should occur out of a phase of compression. Not only that, the gap must maintain its gap integrity. When you couple this with increased volume, you have yourself a very solid trade. Let's look at some examples. Phase of accumulation, gap up. Big move after the gap. That's as bullish of a candlestick as you will get. I love it. That's exactly what I want to see after a gap. A big move. And I don't care that I didn't get in right away, because I know I have my retest entry to help me get in on the next bar. And you know what? If it doesn't fill that retest entry, I know I can still get in with a threshold entry above. I know I can get in. But at first, I'm going to lowball it and see what happens. But look at the accumulation phase. Look at the breakup. Volume increased over average. Not significant, but increased over average. And then it held its gap, it maintained its gap integrity. Very, very bullish. Now, I want to break it down into very simple terms for you. These are the gap play bullish entry scenarios that I use every time I trade a gap. However I'm triggering this entry, whether it's intraday or daily bars, this is what I look for. The best case entry scenarios for me is you gap up. This is the gapping bar. So price was down here, now you gap up. Big bullish bar. If that's a big bullish bar, I know right away that that gap is good, and we're likely going to maintain the gap integrity and continue higher. So what do? I place a retest entry here and hope to get filled. The second style scenario is we gap up and we immediately begin to backfill for a test. The test is successful and you get a huge wick and close at or near the high. That wick right there can be as bullish or more bullish than this one because they wanted confirmation and boy did they get it. And then the price reversed and closed on a high. That is about as bullish as you can get. So if this is the gap bar and you get that relationship, I put my limit at the center of that candlestick and get filled on the next day. Third relationship, price gaps up, builds a very nice bullish bar like this one, but it never comes back to fill my retest entry. So instead, I have to trigger upon a break of that high using a stop market order and a threshold approach. So I'm in here. These are my 3 entry techniques. I prefer these 2 triggers, obviously, but I will get in on a threshold entry if I need to because I don't want to miss that train. Now, when you look down here, these are the worst entry scenarios, which means you don't get into those trades. If price gaps up, this is the gap bar, gaps up to here and immediately we trend lower and close on the low, that is not bullish to me. I don't care. That doesn't mean that price can't turn around and continue pushing higher in the days that follow. I don't care. I'm not trading that because that is not conducive to the pattern that I want to trade. Price gaps up, a little bit of selling, boom, a lot of selling, and we close at a low, I don't care what happens the next day. I don't care because I'm not trading it. Look at this one over here. This one's even worse to me, where price gaps open and then we rally. Oh no, nothing doing there. Instead, sellers pile on and push price back to a low. Again, that doesn't mean that we can't take off and actually rally from that, but I don't care what happens because I'm not trading it. That's not what I like to see. Lastly, it's very difficult to tell here, but this is a tiny candlestick. And if we gap up and form an indecisive spinning top doji type candlestick, I'm not getting in again. I don't care. Because you have bearish, bearish, and uncertainty. And if you have bearish, bearish, and uncertainty, that doesn't lead to a bullish advance. But if you have bullish, bullish, and bullish, it leads to or can lead to a bullish advance. So keep these in mind because this is exactly what I use whether I'm in a 15-minute chart, a 5-minute chart, or in a daily bar chart. Another best case scenario is for the open to be outside of the accumulation phase. So if we gap up and the open is outside the actual phase of accumulation or distribution, that is very, very good. At that point, then you just use a retest entry, get in there, and you're in. Very nice. You want the gap to be outside of the accumulation phase. That helps. What about here? We didn't quite gap completely beyond, but it was a very good attempt. We came down and formed that bullish wick that I talked about. Very nice. If you have to be in on this bar, on the first bar, obviously, you need to get in either using one of those relationships I talked about 2 slides back about the worst case and best case scenarios. Use one of the best case scenarios in a 15-minute time frame. Or use an opening range, reversal, or breakout to get in. Same thing for the second bar. You can do that as well if you missed your stop market threshold entry. So let's look at that in an intraday time frame. Here's that bar that we were just talking about. And then we gap up. Well, if you have to be in on the first bar, use the opening range breakout to trigger your entry. Boom, when price goes here, you either trigger this entry or you let a closed price above it dictate a retest, whatever you do. That's your entry. Or you can wait for price to come back, have a reversal, opening range reversal somewhere in this zone and get in here. Or You can let the first 15-minute bar play out. If the first 15-minute bar looks like this or looks like this, trigger your retest entry and now you're in and you're done. So there's a million ways that you can get in. I've taught you a whole lot of ways. Mix and match, share with your friends. You will get better and better at getting these entries, and you're going to see that it's going to do wonders for your bottom line. What about here? We get a beautiful, look at this accumulation phase. Months of accumulation, 1, 2, 3 months of accumulation. If price gap's out of that range on high volume, it's telling you, done. The accumulation phase is done and we're ready to party and start the markup phase. And that's exactly what happened. Look at months and months and months of movement. So not only can triggering an entry here lead to a nice 5-day swing move, which this course is all about, triggering this entry can also lead you to have a very nice multi-month position trade. So you can take your profits on half the position on that swing trade here, and then, you know what? You can let the trade linger for the next 3 months because you're confident that we're going to see a very nice upward trending behavior. All right, let's talk about range-based setups now. Average price range of movement. We're going to look at 3 and 5 bar multiple day ranges. And we're going to look at these ranges and helping us predict potential expansion or contraction ahead. The first one we're going to talk about is the N-bar wide range setup. N-bar, meaning 3 or 5 day 5 bar range, is a pattern that develops when the current N-day range, 3 or 5 day range, is the widest of the last X number of periods. Now, I use 10 or 20 because that is standard. So if you look at the 3-day range and it is the smallest 3-day range over the last 10 or 20 periods, this usually leads to a breakout. If it's the widest of the last 10 or 20 periods, it usually leads to range contraction. So you can see right here, 1, 2, 3 bars. The range from low to high is the widest range from here to here that we've seen over the last 10 or 20 periods. That usually leads to range contraction in the upcoming period. So this is not used so much as a setup to trigger an entry, but more as a warning or as a method for price forecasting. After a huge move like this, if this setup triggers, you know that the upcoming period of time is likely to be very small, so proceed with caution. Here we go right here. This is a Tony Crable price pattern. So like an inside day, outside day, all these, price patterns. Tony Crable wrote it in his book, all these various setups. This is one of those setups. And this is what you're looking at. For example, if we're using 3-day ranges, here's the first 3-day range. Okay, you have day 1, day 2, day 3. The high minus the low is 45 points. Now you drop the oldest day and you add the newest day, and that gives you the next 3-day range. Still 45 points. You drop the oldest day and add the next day, and that gives you a 3-day range of 30.75. And you go on and on and on. When you finally come up to a day where that day is the widest of the last 10 periods, that is usually a strong indication that the price range over the upcoming 3 days will be drastically smaller. There's a success rate of nearly 80%, and the price range of the upcoming 3 days usually drops by 40%. In this case, this was an actual day where this occurred. In this case, price had a price range of 50.75 over that 3-day period. The price range over the upcoming 3-day period dropped to 25.25 points, a drop of over 50%. So let's look at that. This is the exact scenario that we just talked about. High minus the low over this 3-day period is 50.75 points. It was actually a 3-bar wide range setup over the last 10 periods. That led to a very quiet move in the upcoming 3-day period of 25.25 points, a drop of 50%. And this just shows you the revolving nature of ranges. Multiple day ranges. A high multiple day range typically leads to a low multiple day range. So either stop trading altogether during that range or change your approach to tailor to that style of trading. Use closer profit targets, use reversal methods, whatever. You're probably not going to break out. That's the case. What about here? We have a 5-bar wide range signal. Boom, 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 boom. These 5 days, the widest of the last 10 periods, that forecasts very quiet behavior coming up. And here's an indicator down here that I created to help me identify those points. Below in blue are the wide range, which leads to very quiet trading behavior. And of course, the reds above are the narrow range setups, which we'll talk about next, which usually leads to price expansion. But look at this. Boom, high range from 80 half down to about 73 half. And the range for the upcoming was about 73 to 76. Very small. When we're talking about narrow range bars now, we're looking at the N-bar narrow range pattern. And if we have a narrow range, multiple day range, that usually leads to price expansion. So just like the last setup, this setup, if the 3-bar range or the 5-bar range is the smallest range over the last 10 or 20 periods, that usually forecasts a breakout ahead. Look at this, 1, 2, 3 bars, very narrow range. That usually leads to boom, 1, 2, 3, a high range in the upcoming 3 or 5 day period. This is usually a breakout signal, so you might want to use the opening range breakout or reversal entry, or maybe even a threshold entry. So this is another example, an exact example, where you see a 3-day range of 37.75, a 3-day range of 30.25, so on and so forth, and boom, look at this. The 3-day range here was only 28 points, 28-point quarter. Boom, none of these were in the 20s. That's how narrow this was. This range forecasted range expansion of 115% over the next 3 days. So it went from 28 quarter, the next 3-day range was 60.75. This has a success rate of upwards of 90%. And not only that, the range expansion that occurs, price range usually expands by 74% in the upcoming period of time. That's huge. So when you're looking at this, 1, 2, 3-day range, very narrow, 25 quarter, very narrow compared to the average, going backwards, the smallest of the last 10-day period, or the 10 MDR period, that leads to a price range of boom to boom, 55.5 points, 120% increase. Is that right? Wow. Huge move. So what do you do to get in? Well, lots of ways. You can look for a confirmed breakout from the range, so use a stop market order here. This bullish wick on that first day of the new period told you that we're probably headed higher because it's a huge bullish wick. You can put a retest entry at the center of the wick, get filled here. Right? You can use an opening range relationship on the second day or the first day. You can do a lot of things. But just know, if you get this pattern here, it usually signals an upcoming expansion phase. Here again, I got a setup on this indicator where it says boom. This is a 5-bar narrow range setup, the smallest of the last 10 or 20 periods. Now you know that we're probably going to see some range expansion ahead. So you can use a stop market threshold entry for the breakout. You can use a value area reversal intraday, an opening range reversal intraday. You can use the retest entry. You can do all kinds of things. Just get in again. Remember, this setup, like all the other setups, has to form in the midst of normal trading range behavior. You don't want it to happen over and over again, because you don't want this setup can form all day long inside of a very narrow trading range. That doesn't mean anything. But if it forms in the normal scope of trading behavior, it usually leads to a very nice move. Look again. This is what I'm talking about. An established markdown phase, very nice, pullback, pullback, and now we're in that pullback zone again, but we formed a 5-bar narrow range setup. that can help you identify that we're ready to expand on the next down phase in this markdown period. And you put your stop market threshold entry here on the last bar of that 5-bar setup, and you're in here. How do you find this, by the way? Well, you can have a simple spreadsheet and calculate the 3-day range in a spreadsheet. So every day you're looking at the last 10 and it's spitting it out for you. I have a spreadsheet already set up I can send you. Or I can send you the code for this indicator if you use Nirvana products. Or I can send you the code anyway and you can have it coded up for whatever platform that you use. Just let me know. I'm all about giving you what you need to help you find these setups. Now let's look at actual statistics for these setups. This is a 14-month test period for the E-mini S&P 500 in daily bars. I used a random blind test period from last year that headed into the beginning part of 2011. And you can see here, this is the 3-day statistics and the 5-day range statistics. Narrow bar statistics for 10 and 20 periods. Wide range for 10 and 20 periods. This is the number of days in that test period. This is the number of times that setup triggered during that test period. For example, this 3-bar narrow range over the last 10 periods triggered 36 times in the 289 days. That's 12.5% of the time. The average 3-day range during that test period was 40.73 points. The average narrow range was 26.85 points. That's a change of 34%. Of the 36 that triggered, 33 were profitable. That's an average of 91.7% of the time. The average change was 73.7%, more price range. So if the average was 26.85 as a narrow range, the average move that came up was 73% higher than average, or than that move, this range. That's huge. So you can see that these setups actually worked. Hit rates of 90%, hit rates of 70% for the wide, and an average drop of 35% and 40% for the wide range setup. Same thing for the 5 bars down here. The average increase was between 50 and 60%. The average drop in price range was in the high 30s. All of the hit rates, the statistics, are above 60% and mostly are in the 70s and 80s. Very, very powerful statistics. So these setups do work. You just have to know when to use them at the appropriate times, and you have to let the setup tell you, help predict future price movement. So here are my final thoughts for part 2 of the course. Basically, discipline, patience, and technique. These are the most important aspects to triggering successful entries. You have to have patience. You have to have the proper technique, which we discussed. You have to have the discipline to only trade during those periods of time that offer the highest probability odds for success. Remember, it's all about trade location. You have to be disciplined in requiring a great entry every single time. You have to know the various pro-style entries like the back of your hand, because you have to know when to use them. You have to have your quick wits about you to use them. Even if you get passed up on a trade, you have to know to use your backup entry and your next entry. And you know what? You have to be able to know how to enter on an intraday basis if you have to. Also, remember, the setup is not what makes the money. It's not about the setup. As a matter of fact, I don't even like teaching setups, because I want to teach you to be able to identify value setups in the normal course of trading. I don't want you to have to be dependent on the setup. The setups are here in order to help you identify what it looks like when a profitable opportunity is beginning. But I provided these setups to help you identify periods of time that offer great entries into the market. Lastly, practice leads to confidence. Practice, practice, practice. It builds your confidence. Ironically, confidence, though, is gained through experience. So you have to continue to employ these techniques in your actual trading, because as you see that your trading entries get better and better and better, you'll see that your bottom line gets bigger and bigger and bigger, and this leads to experience and confidence. And that concludes part 2 of Swing Trade Pro, swing trading setups and entry techniques.